Royal Financial Investment Group. My name is Prince Dykes. As always, coming to you guys with another great topic. Today's topic is going to go over mutual fund and ETF fees. Mutual fund and ETF fees. But before we jump into the topic, don't forget to like, subscribe, comment, share, all of the good stuff. You got any questions, issues, or concern, or feedback? Drop it in the comment box below, and I will definitely get back to it. But I don't have a lot of time, and I definitely know you guys don't have a lot of time, so let's get straight into it. Today's topic, like I said, mutual fund and ETF fees. If you don't know what mutual fund and ETF fees are, then just check out my other video. I had over 100 and some videos up. Just check out one of those videos to tell you what it is. But if you clicked on this video, I'm guessing you already know what it is. So let's get into the reason why we need to look into fees. If you haven't read the book called The Intelligent Investor, I think, it made a great line in there where it says low fees means increased returns. Low fees, increased returns, something of that nature. And essentially what it's saying is that, the lower your fees are, the higher your returns are. For example, let's say if two people won $10,000. Person A won $10,000, person B won $10,000. But person A has to pay, let's say, 50% in taxes or 50% in fees, administrative fees. He has to pay 50%. And person B has to pay 10% in administrative fees. Who is going to take home the most amount of money? Person B, right? Because person A, they both won the same amount, but person A had to pay 50% in its fees and expenses, which is going to leave them with $5,000 versus person B, who also won $10,000 but only had to pay 10% in fees, which leaves them with $9,000. So when you look at it, you say, wow. So that's why it will behoove you to say, hey, I want low fees so it won't cut into my investments. That's why low fees equals increased investments, right? So let's look at it. Let's go a step further. Here we have Etrade pulled up, and you go to Etrade, you go to products, and you go to mutual funds. Right? So mutual funds, why do mutual funds have fees? As we all know, mutual funds are a group of stocks put together, and those things cost money. Mutual funds are up to $200, $400 million, depending on how big they are. Those are fund managers. They're actively managed, meaning that the assets in the portfolio are constantly being moved. People have to do research to see what they're going to do, take out, put in, how they're going to change the strategy, how they're going to meet with the strategy. They're constantly trying to beat the benchmark, which is the S&P 500. So it's actively managed. So that means that somebody's every day looking at this stuff. It means that they have to get a paycheck. So how do they get a paycheck? They get a paycheck through fees. Also legal. To manage that type of money, you have to have, you have to have accountants, and you have to have lawyers, and you have to have all these other people put into play to make a fund like this run properly. So those things are what are paid for by fees. These people have to get paid, right? So now, how is the fee calculated? It depends on the mutual fund, depending on how they set it up, and that's what we're going to get into. So as what we have here, you go to research, like I said, products, mutual funds. When you come here, this is the mutual fund screener where you can check out not millions, but thousands of funds that they have here on Etrade, right? So, you can go in and, categorize how you want to do it, but we want to pay attention to down here where it says fees, where it has load, no load, and no transaction fee, and load waive. What is a load? A load is essentially, let's say you say, hey, I want to buy a mutual fund. And the reason why mutual funds are very attractive nowadays, because when you go to the market, this is the first thing they tell you to go to, which is not a bad thing. So let's say I have $1,000 I want to put into a mutual fund. A load can be anywhere between 3% to 8%. I think it's 3 to 8.5. 3% to 8% is what they're going to take off the top of your investment. So you pay $1,000 to a mutual fund. It's going to take $1,000 off the top, and then it's going to invest the rest into the mutual fund. Now, depending on the mutual fund, depends on what that load range is. That's called a front load when you pay it in. You pay it as you're going in. So let's say you say, hey, you put $1,000 into a mutual fund, and it could be a back load. A back load or a deferred load is when you go to sell that mutual fund. So it takes you have $1,000, you put $1,000 in. Once you get ready to sell or take that money out, then it's going to charge you on the back end that load fee. That's what a load is. Now you see the word no load, no transaction fee. I told you what a load was, but this one doesn't have a load. A transaction fee is how brokers make their money. You know, brokers, for example, Etrade, how does Etrade make its money? It makes its money from when you buy a stock and when you sell a stock. Because when you hit that buy button, that's going to trigger something all the way to the New York Stock Exchange that has somebody on the floor that's going to press the buttons to make sure that money gets to you. And those people need to be paid as well. That's what's called a transaction fee. That's how brokers get paid, from 4%. I mean, not 4%, but I've seen some low as $4 all the way up to $100. That's how brokers get paid, when they buy and when you sell. That's how they make their money, right? Now this says a transaction fee. A transaction fee, let's say you get a mutual fund, you put in $1,000 and you say, hey, I'm just going to put in $100 a month. Now pay attention to it. A transaction fee is when you go to buy more shares, it's going to charge you $10. So at the end of every month, you get in charge $10 when you put your money into the mutual fund. No load load wave means that you know the load is wave. Now economically, since I just went through all of these, economically the one that makes the most sense would be the no load, no transaction fee in most cases, because you're not paying anything on the front end or the back end, and you're not getting charged a transaction fee every time you pay in. But that does not mean expenses are not calculated. Like I said again, they have to make money some type of way. So you're saying, Prince, how do I see what the expenses are? So for example, I'm just click the view matches button to pull up a random mutual fund, and we're going to look at something called the gross expense. So I don't even know what this mutual fund is, but I'm just click on it, and we're just going to look at the gross expense on it, right? So as here it's just pulled up, you go down here and you see gross expense. Like I said, the gross expense is how much money do you have to put inside of that investment for it. Is that not how much money you have to put inside the investment, but how much money it's going to cost to run that investment. Administrative fees. This one is 1.75. Now, don't get this confused and say, hey, I get a mutual fund, I have to pay this money out and stuff like that. No, what it does, as you can see this fund here, when it says net assets, it's for $436.8 million. So what happens is, when you have that type of money, you're managing $400 million, you are going, what the fund managers are doing, they're taking 1.75% off the top. Every year, annually, they're taking 1% every year of what they manage. So if it goes up to 500 million, they manage it and they still get 1%. If it drops down to 100 million, they still get their 1%. So you are not paying anything per se once you invest into that mutual fund, but they take that off of whatever profits, gains, or losses that are in that fund. They're taking that money out. So the more money they take out, the less money that you get. That's why it's a good idea to pay the gross, to pay attention to funds. So now this is a great tool. You see this button over here where it says more fees and expenses. This is a great tool that Etrade has, that you can go down and you have a chart here where you can compare. It takes for example, it says, hey, if you take a $10,000 investment, this is what it's going to cost you in a year, 3 years, 5 years, 10 years, right? And you can see how those fees are adding up. And you can compare to other things. You can put in your estimated annual returns. You can compare it to another fund. Say, hey, I want to know which fund is whatever, right? And you can compare the two to see how much it's going to cost over time. And as you can see, out of that 1.75, it's giving you the management fee, administrative fee, and a 12B1. When you see this word right here, that just means an annual fee. Fancy word for annual fee. And this is how they make their money. They take their money out of the mutual fund. Once you throw your $1,000 in, there's people all around the world that's putting in their thousands and tens and millions of dollars into this fund, and they're taking their money off the top, whether it's gains or losses or whatever. This is how they manage it. So that's one thing. Now let's go over to ETFs, right? Exchange traded funds. We're going to go to the same place, research, products. We're going to go to ETFs. Now, ETFs are different from mutual funds. If you haven't seen my video, mutual funds versus ETFs, ETFs are more passively. And when I said mutual funds are more active, ETFs just track things. It just tracks gold by buying and selling derivatives or whatever. It just tracks things. It doesn't, if I'm just tracking something, that means that when I'm tracking something, it's passive. I don't need to go in and touch something. I'm just tracking gold. Or I'm just tracking the Dow Jones or index. So you're just tracking. So it's usually less expensive because people don't have to be in there managing things, right? So we're just going to pull up a random ETF and we're going to take a look at the expense, right? So just click on that, and you go here, you go down here to the expense ratio. It's 0.95. Now if you got a question like, hey, I don't understand what he said, I want to say it again, of course you can rewind this video, look at it as many times as you want, but you just click on the question mark at the expense ratio and it'll tell you what it is, right? And it's your management fee. This one is 0.95. Annually, 0.95 is what you're going to pay. Not what you're going to pay, but what it's going to take out of that fund. So the more that they're taking out, the less fund, because you want to buy it. For example, this one is trading at $21.89 today. You want it to get up to $30, $40, $50, and $60. The more money that a fund manager is taking out of that, it can not let it grow as fast or like you want it to. Since it's not paying any dividends or anything, the only way you're going to make money is if it goes from $21 to $30, $40, $50. So it's in your best interest that this fund goes up, right? In order for it to grow. And it's ETF. So that's one of the things I wanted to bring up. I know a lot of people, they don't look at that. When they tell people to get a mutual fund, they pick a category and then they don't think about the fees. How are you getting paid? Who's getting paid? How they're taking their money out? Good questions to ask. And this is something that you can use, a great tool you can use to look up fees. But thank you guys for watching this video. Don't forget to like, subscribe, comment, share, and leave me some comments below. Tell me your thoughts. And if you got any questions, make sure you drop those too. Thank you guys for watching. Until the next video, be safe.